Major Macro Market Review. Your host today, Ron William, FSC Development Director. Interesting time of the year as we hit that year-end rundown to look back at the time that has passed, markets and cycles, with a focus on what will likely happen next. So that's what we hope to do today. And our key focus will be an overview in terms of the approach used by myself at RWA in terms of the blended mix of macro and tactical. The roadmap signature, originally developed by my mentor Robin Griffiths, what it is and what stage of that model we are likely in, and then more importantly, macro cycle insights, big picture. What are the latest highlights? And then from there, we look at practical, actionable global ranking outlook and close on key insights. So let's begin with macro cycle insights. Essentially, the approach at RWA is top-down framework. It's blended between macro and tactical, essentially driven by both a behavioral and timing component. Now, the timing side is cycle specific as part of the roadmap signature cycle, which I'll share in a moment, but also the business cycle, which is mapped out as well at the Foundation for the Study of Cycles, and a range of other timing patterns, including seasonality. And then just lastly, something I'll share in a few moments and have done previously is the global ranking model, which is a quant-guided framework allowing to look at global cross-assets, both in absolute and relative terms. Now, for those of you viewers who are keen to learn more, look out for the book Mapping the Markets, co-authored by my mentor, Robin Griffiths, just there on the right, for further educational resources. Now, the actual practical work in action is this roadmap investment model. It continues to suggest a late stage cycle. We've been in it for some time, but of course there's been an ebb and a flow, some lag, and at some stages, overextension more than expected. But there continues to be, a likely growth contraction, credit pressures to follow, and a rotation of sorts in a sector standpoint where growth typically hits a pressure point, value outperforms in the short term, but ultimately volatility returns. And the equity market outperformance, which is typically driven by concentration risk, then starts to unravel. Now, the recommendation here is a barbell strategy where we continue to trade what makes money. The trend is your friend, but we do it selectively in terms of the risk asset mix. And ultimately, those of you that have made money, as many would have in the first half of the year, look to take profit and protect some of the downside risk that invariably builds up in a very strong trend with asymmetric risk that traditionally follows. In parallel, we look to build defensive plays such as gold. That's already been strong in absolute terms, but keep in mind relative outperformance and just general risk diversification, as well as other diversifiers that can help. That's the blended approach in action in terms of a growth valuation and technical checklist framework, which we can all recreate in our own way, but ultimately it gives us a systematic process to follow when mapping out the market. Now, the actual fractal cycle is this roadmap boom bust cycle, again developed by my mentor Robin Griffiths, and you can see here it's asymmetric shape, mountain climb up, cliff drop down. Essentially, that's the unequal relationship between greed and fear, and the typical shape to a bull and bear market. It looks a little bit like the Elliott wave pattern, but it is different with a variation in terms of labeling, shape, as well as the business cycle overlay. And here and now, it suggests that equity markets remain late stage between W, X, and Y. Of course, Y has superseded W, and we now have all-time highs in risk markets generally, and specifically equities, US being a case in point. Now, ultimately, when that extended rally hits a momentum pressure point, unwinds and reverses, then we will likely get a realignment with this cycle. Now, the economic cycles that drive that roadmap cycle is based on the work of Joseph Schumpeter, a Harvard professor from way back when, that recognized the work of other cycle practitioners such as Kondratiev, Jugular, and Kitchen. We've long documented and provided research insights on each of these cycle pioneers and their cycle work. But just to reframe, the one that matters the most here and now is the business cycle, which, according to the Foundation for the Study of Cycles and the work of our co-founder Edward Dewey, ranges up to a 41-month duration, i.e. 3 to 5 years, did top out early this year, but the big move down is likely in 2026. And the difference between the two is basically what we've been living through and trading for the duration of this year. Clearly, the bulls have been the outlier surprise expectation, and the cycle has stretched, but still that asymmetric risk remains intact for early next year, according to that same model, and that is the third cycle down on this framework. Now, one up is the jugular cycle, and that typically aligns with the decennial cycle. That has been positive this year, more than the historical average. I will throw my hands up and say it went against my expectations because I'm aware of the fact that this cycle works more often than not. Fifth year is a sweet spot of the decade and the best time to buy and hold. But there are some outliers, and I've been highlighting those risks earlier on this year. In the end, the stats proved out, and the decennial cycle played out not just as expected, but more than expected. And now the question is, will that continue into year-end as part of the year-end rally in terms of the seasonality upside ahead? Or do we get an elastic band unwind, given that the market is so overstretched here and now? Lastly, I just want to say a quick word on the Kondratiev wave. This is such a big cycle that most people care less for it because it's too big to track and to actually care about. But it does influence interest rates, inflation, and social mood extremes on a generational basis. And certainly this does suggest that the cost of living will continue to rise. The inflation and rate shock that we saw in 2022 will resume. And that could be a risk for the next 6 to 12 months and beyond. We still have to continue to track. Now, inflation figures have come out of the US softer than expected. The Fed has already cut and is expected to maybe do so again. But there is a likely resurgence in commodity asset price inflation, and of course the reckoning of government debt itself in due course, which remains a pressure point for us to watch, including potential disruptive forces such as geopolitics that could follow over the next year or two. So it's a long cycle, difficult for us to track, and most people won't look at it day to day, but do keep in mind as this will provide a surprise factor if and when it resumes. Okay, let's look at the global ranking model in terms of actionable tactical short-term signals. Here we're looking at trend performance over time. It is a measure of long-term, medium-term, and short-term using trend filters, moving averages, the 200-day, 50-day, and 20-day. And there is also a filtering of cycles for each of these markets, global cross-asset. Now you can see from top down is the strongest markets, and the reverse are the weakest. Gold was strong, but clearly has had a sharp but likely limited unwind. Remember, the relative outperformance is still key. It will continue to, it has outperformed all markets. It's already been up 50% in half the year. And likely, I think if you look at it from a multiples perspective, it's 3x the performance of the equity market, which is big enough of an outperformance. But even if it were to correct here and now, and it already is, as that continues, it will still likely be stronger than cross-asset markets like the equities. And so for that reason, in absolute and in relative terms, as well as risk diversification, gold remains key. Of course, you can take some profit, look to buy on the current dip that is taking place, or for some of you who are a little bit more aggressive, maybe a short trade for limited time. But my recommendation would be buy on the dip and relative performance as an opportunity ahead. Then we also have Ethereum, which is a digital asset, yes, but also a risk appetite proxy. And with the unwind that we've recently seen, it could be showing early signs of risk-off shift, followed by gold in terms of the momentum chase that we've seen. Yes, it's a safe haven, but at the same time, it has been a strong momentum play too. And then, of course, equities is part of that return chase, with the US at a climactic high, but Asia offering better value with a lag effect in terms of performance. And either way, in the equity space, look for a likely Q4 year-end and New Year new volatility regime. A little bit more to speak on that in a few moments. And then lastly, that macro surprise factor remains inflation, re-emerging as part of a rotation into what we've already seen now, copper, with potentially oil from extreme oversold lows to add to the leadership, as well as interest rates. Yes, Fed has cut and rates are at key support, but the wave pattern and the cycle timing is suggesting higher for longer, again, into the next few months ahead. So think about each of those different macro themes. I do want to highlight the table just for visual reference. You can see gold here, long-term outperforming, but then unwinding down. US underperforming from its strongest top original signal. China outperforming the US, but now underperforming in the short term. And then on the flip side, if you look at the bottom, rates climbing higher, oil starting to bounce up higher in the short term. I'm scribbling on the slide a little bit, but just want to make a visual reference for those of you that do want to follow this ranking model each time I share it on this FSC monthly vlog. Now let's dive into each of the charts. So gold's sharp but limited unwind is already big. It's below the 4,000 mark. That's previous glass ceiling that we broke above, and likely to retest the medium-term average of 3,780, and maybe further if it overshoots. Even still, think of this as a corrective wave within a long-term strategic uptrend. So this is likely a buy on the dip opportunity based on the trend and the wave pattern. Having said that, the FSC cycle model is suggesting a two-stage move down into year-end, which is what we're seeing here and now, as well as a bounce back into the new year, likely during spring. And that could be after a risk off period where basically some of the fast moving markets, including equities, crypto, and gold, anything that's moved up in what seemed to be a straight line, will go through a stress test. And keep in mind, even though gold is a safe haven, ultimately it is still a money making trade. And so many investors and traders will likely take profit or by choice or their hand being forced if and when volatility kicks back in. Either way, keep in mind that from a relative perspective, gold remains resilient. And you can see here the chart in the bottom right-hand corner, F3, showing that gold will likely continue to outperform equities. And here and now is still early stage within that outperformance setup. Okay, so that's the tactical, cycle, and relative view on gold to keep in mind here and now and for the months ahead. Now let's look at Ethereum. Clearly, this has been the strongest crypto as part of the altcoin complex, but also following the stablecoin announcement some months ago, with Ethereum being part of the technology that will feed stablecoin backed by government transactions in the US. That showed the blast off above 4,000 or into 4,000, but it remains within a range between 4,000 and 5,000 now after becoming very overbought. Now, what's interesting is that also could be a sign of a risk-off unwind when the signal actually took place a while ago. And we've naturally seen a rotation shift between Ethereum and Bitcoin as a consequence. So continue to watch crypto, especially the work of Lars von Thienen, our FSC board member that covers it regularly and often talks about the 200-day cycle, which does look like it's topping out early in this year as well. Look at the work of Michael Howe and Lars von Thienen, where they tie crypto liquidity cycles with liquidity itself globally and how that is confluencing for the same time frame into 2026. But ultimately here, I'm sharing Ethereum as an additional overlay for that risk appetite unwind signal, which already took place early this September. And lastly, as part of our major macro market review, US equities, S&P 500 at a new climax high, but still at risk for downside volatility into the new year of 2026. Some people are arguing for a year-end Christmas Santa Claus rally that may or may not happen. My concern is when the trend setup has already been very strong, then we can also get an adverse elastic band effect in the opposite direction. So carry on trading the trend, make money in that long and attractive trade, which has stood the course of time and also the wall of worry. The markets remain resilient no matter what, but at the same time, do not at any point, my educational recommendation, become blindsided from a behavioral point of view to any potential market or macro risks. And on that educational disclaimer, keep in mind that from a behavioral standpoint, sentiment is the most complacent since 2022. So it's a record extreme. But more interesting than that is that in 2022, just some time ago, the market consensus flipped from strong trends, low volatility to the exact opposite. And we had a roller coaster ride for the duration of that year. We also had a revival of inflation and rate shocks, as well as geopolitical risks. So does history have to rhyme? No, this time can be different, but there are echo patterns from the past that often resume into the future, particularly when we're at a behavioral inflection point, and that is likely the case here and now. Does that mean that you switch your trade from long to short? No. Does that mean that you stop following the trend? No. But it does, at the very least, suggest that you stay vigilant of any change of market condition, because after all, change is the most constant factor both in life and markets, and a key part of being successful at trading and in applying cycles is adapting to change. And so the change that is projected to happen according to the FSC model, we can see here at the bottom right, is for an asymmetric risk shakeout into year end and the new year. Now, it could be a shallow correction, doesn't have to be a big fall. So that's the base case scenario. But keep in mind that the extreme risk scenario is predicated on the business cycle read, as measured by the FSC, a 41-month cycle. But based on the spectral analysis, the shakeout of that cycle, the greater move likely into the new year of 2026, that also chimes in with liquidity cycle work from Michael Howell, which has also recently been combined with Bitcoin liquidity cycles by our FSC development director, Lars van Thienen. So we'll see how that plays out. Ultimately, the market needs to show evidence of an unwind and reversal. On the S&P 500, that would be a move below 6,600, and time will tell. We'll spotlight any changes in the near term as and when they take place. Now let's close on some key insights. Remember, the adaptive edge to successful trading performance is all about, yes, risk management, not making money, but actually keeping that money that is made and making sure that we're being vigilant about how we're both managing the trade, but also managing the risk. This chart here on the left, which has done the rounds across various investment banks around the world, shows that if we miss the best 10 days versus the worst 10 days, the latter is going to outperform significantly, because ultimately fear outperforms greed in volatile market regimes. Now, so far, greed has outperformed fear in this most recent cycle of 2025, but nothing goes up in a straight line. And if it looks like it does and feels like it does, guess what? At that moment in time, or in due course, the coin flips. And that's where we have to take care, particularly, in terms of, switching from FOMO, fear of missing out, to FOLO, fear of losing out. That's the main message behind this performance equity curve scenario, showing best and worst days of outlier moves. I will include, some of the quotes from the all-star investors of Warren Buffett on risk management and Stanley Druckenmiller in terms of his worst trade in early 2000s. You can read the notations there. I've shared this before, but certainly this is an important time for us to at least be vigilant of changes in the market. And then just lastly, keep in mind tail risk scenarios. We've seen lots of upside surprises, which is markets basically proving their resilience. Certainly the market has been continuing to climb that wall of worry, and if it does, carry on trading what you see. But the moment that things change, keep in mind some of these tail risk scenarios: cycle risk, Fed policy mistake, which is likely at some point, recession actually proving out in the data, and potentially that legacy geopolitical shock. Although, yes, the Middle East seems to be in an early stage peacetime, there are still concerns in the region, as well as Russia, Ukraine, and potentially other. I shall close on that. We gave an overview of the framework just to refresh and ground in terms of my way of looking at the markets, and hopefully some insights that each of you can consider for your own frameworks in looking at markets and cycles. Then we looked at the global ranking model, what it suggested about gold, Ethereum, equities, and inflation. And then lastly, we closed on key insights, the adaptive edge, and tail risk scenarios likely ahead. That's it all from myself, Ron William, FSC Development Director, as well as Global Cross-Asset Tactical Strategist at RWA. If you'd like to stay in touch, feel free to connect on social. There's a QR code there for LinkedIn and details for the FSC email handle if you want to contact direct. Thank you. Welcome any feedback and questions. And please, if you find our work useful and insightful, like, share, and comment on our video content. Thank you very much.